Alright, so I'm going to do a quick review of the final exam. The final exam will cover chapters 5, 6. So these are the two chapters from before, and then the three new chapters after the second exam, that would be chapter 4, chapter 18, and chapter 13. I've listed them here in the order that we covered them in class. So for the purpose of the review, I'm going to actually focus mostly on chapters 5 and 6, since other three chapters are relatively recent, right? We just covered them. You also had chapters 4 and 18 on the quiz as well. We just finished chapter 13. So I'll focus mostly on chapters 5 and 6 and the things that you need to focus on from those two chapters. So this is the core part of the course, right? Talking about risk and return diversification. So that's the reason why I'm including them in the final as well, so that you can review them one more time. Okay. In terms of the logistics for the final, it would be actually just like the midterm exam. So it would be just like a third exam, basically, not really like a final. You will have about an hour and 20 minutes, just like we had for the midterm. So you'll have about 80 minutes for the final. You will have about 30 multiple choice questions for the final from these five chapters. Okay, so I'll send out all those details and timings and stuff like that over email, most likely tomorrow, or in a day or so, and then so that you have that information. And again, the link for the final exam would be available on Titanium. You will be taking the exam on the day that your university final exam schedule shows. So the exam will start at that same time, but the exam won't be an hour and 50 minutes. It would be an hour and 20 minutes. Okay. All right. So chapter 5 is on risk and returns. So let me just go over the PowerPoints and show you some of the things that you would be responsible for. Holding period return, arithmetic average, and geometric average. So these are the various return metrics. So make sure you know the basic holding period return calculation. You know how you should know how to calculate arithmetic and geometric average. What's the difference between the two? Geometric average is more relevant for a buy and hold investor. Arithmetic average is more useful for estimating the expected return, right? So we talked about this. You can skip over this part here, the relationship between APR and EAR. So for the purpose of final exam, you don't need to worry about this. So you can skip that. You should know how to calculate the expected return and standard deviation from the scenario. So this is the example that we worked on in class. So make sure you are able to do this type of calculations from the scenario analysis, right? So expected return and standard deviation calculation. Okay. Then risk premium and risk aversion. What is risk premium? Risk premium is the expected return on top of risk-free rate, and higher the risk aversion, higher would be the risk premium. And then alongside this discussion of risk aversion and risk premium, we also introduced this important metric, the Sharpe ratio, which we also talked about in chapter 18, right? So the risk premium over standard deviation, right? Reward to risk ratio. So make sure you know the Sharpe ratio calculation. You don't really need to worry about the historical record. This was just to illustrate the risk return trade-off in the historical data. So you can skip over this part here. You don't need to worry about the relationship between inflation and real rates of return and nominal rates. So you can skip over this part as well. You should know this last part here in chapter 5. This is the analysis of risky and risk-free portfolio, right? So this is how to allocate between risky and risk-free. So we looked at examples of this. We learned about the capital allocation line, right? So this is the capital allocation line. We learned how the slope of capital allocation line is the Sharpe ratio of the risky portfolio or any portfolio that lies on this line. We also learned that all portfolios are equally good in terms of their Sharpe ratio. So there is no single optimal portfolio that stands out, and investors would choose their allocation based on their risk aversion, right? So make sure you are clear on all of these different concepts. All right, so on this document that I have emailed to you, you have all of those things. I have skipped over the things that I just mentioned that you can skip over, right? So you should know all the different types of returns, calculating standard deviation and expected return from the scenario, concepts of risk premium, risk aversion, and Sharpe ratio, and the risky, risk-free allocation, right? So that's the complete portfolio analysis. From chapter 6, so this is on diversification. Here our focus was on the risky portfolio primarily. So what is the distinction between market risk and systematic and firm specific risk, right? So systematic and unsystematic risk, and why only the firm specific risk is diversifiable and why the market risk is not diversifiable. We talked about that, and then we introduced covariance and correlation as metrics to capture the relationship of returns between a pair of securities. So make sure you understand this conceptually, make sure you're able to do the related calculations of covariance and correlation. Okay, and then we used correlation in our uh, analysis of two risky asset portfolio, right? So these are the relationships. The return equation is the same. Standard deviation in this case is this non-linear equation that includes the correlation, right? So how we get the diversification benefit, we also illustrated that analytically with our class example. So again, make sure you're able to do these type of calculations based on the two risky asset case formulas. Okay, and then this is the plot, risk return plot for the risky two risky asset case. This is what it would look like for multiple risky assets as well. Then we looked at the impact of correlation on diversification. So some conceptual stuff here, but then the one of the other things that we learned is that when we bring back the risk-free asset into the mix, then we get the tangency portfolio as the optimal risky portfolio. The tangency portfolio is the one where the capital allocation line is tangent to the efficient frontier, right? Uh, so that is something that you need to be familiar with. All right, and then so you can skip over the calculations. We didn't really do these calculations here, so you can skip over some of these parts here. Just know this conceptually, that the optimal risky portfolio is the tangency portfolio, right? And then we have the separation property, so we can sort of divide our overall portfolio choice problem into two parts. One is how to figure out the optimal risky portfolio, that is purely objective, you can do the math to figure that out, and how to allocate between risky and risk free, that is purely subjective based on risk aversion, right? So that is the separation property. So that is what we covered in chapter 6. All right, so that was just a recap of some of the highlights from those chapters and going over the things that you are responsible for as far as the final exam is concerned. Uh, just very briefly, from chapter 4 on mutual funds, if you look at the reading assignment, I'm actually asking you to read over all of this material. Mutual funds is an important topic, has a lot of practical applications. Perhaps most of you at some point would be investing in mutual funds. So I think it's a good idea to be familiar with the various aspects of mutual fund investing. All right, so make sure you go through this, review all of the material from chapter 4. Performance evaluation, as far as the calculations are concerned, the calculation is about would be related to these 5 performance metrics: the Sharpe, the Trainer, the M2, the information ratio, and Jensen's alpha. And other things would be conceptual, right? Talking about style analysis and morning star ratings, and how performance attribution is done. Again, for that part you only need to know the concept and you don't have to worry about any calculations there. And towards the end we briefly talked about market timing as well. Chapter 13, we just went over the calculation problems from chapter 13. Most of the calculation problem would be related to the dividend discount model. And most of our discussion was focused on dividend discount model. For the free cash flow valuation, again, just focus on the basics, how to calculate the free cash flows, both the free cash flows to the firm and free cash flows to the equity holders. And then once you have the free cash flows, then you just need to discount those to get the present values and arrive at the firm value or the equity value. If you discount the free cash flows to the firm, then the discount rate that you need to use is the weighted average cost of capital, and the number that you get there is the firm value. So from that firm value, you need to subtract out the value of debt to get the value of equity. If you use the free cash flow to the equity holders, then the discount rate would be the cost of equity, and there you directly get the equity value of the firm. Okay. As far as the dividend discount model is concerned, we talked about the no growth case and the constant growth case. We learned about how to estimate the growth rate as a product of ROE and B. We introduced this concept of present value of growth opportunity. So present value of growth opportunities is basically total value is broken down into the no growth component and growth component. So no growth component is calculated assuming that all the dividends, all the earnings are paid out as dividends. There is no growth, so there is no retained earnings, and that would be the no growth component. And then whatever extra value is there, that is the current value of growth opportunities. That is what we refer to as PVGO. And then we talked about the PE ratio, how higher risk leads to lower PE ratio, and how higher growth rate leads to higher P ratio as long as that growth is value adding, right? And we learned how to actually do that analysis analytically based on the dividend discount model. All right, so those are some of the highlights from chapter 13. So I have emailed you this document, and I'll send you some other information related to the final exam over the next day or so.